All right, so first of all, I just wanted to welcome everyone and being here and supporting us. For those of you who don't know me, I think most of you guys know me, I'm Lala, and this is Sandra, our senior loan officer and also loan processor for Champions Mortgage. And before we start, I want to do something fun because we always like it so serious. I want you to turn to your neighbor or next to you and say one thing that you're grateful for today. One thing. So turn around to someone and say what you are grateful for. One thing.
I'll just turn around and say my name. I am grateful that I can walk.
Yeah, I'm grateful
Chris, what are you grateful for? That's something to be grateful for. Your family.
Thank you guys. Thank you guys. So we're grateful for you guys being here and supporting us and learning. So one of the things that we wanted to bring forward. Okay, there's the same grateful. Guys,
I'm very grateful.
Yeah, very grateful. So I just want to say we're all grateful for you guys being here and also for sharing the space. One of the important things is, especially right now through the changing market, is getting educated and learning about different programs out there. You know, most of us are familiar with the conventional, the FHA programs. So one of the things that we wanted to bring forward with Champions Mortgage is getting really creative and bringing alternative options for our buyers, especially the buyers that are low to moderate income. So there's a lot of people out there that want to buy, but they're getting pushed out either because of the rates or possibly because of the income. You know, the income is not there, or they're just like right over the debt ratio. You know, they need more income maybe from a parent or a spouse. So in bringing this forward, our intention for the Champions Mortgage is to have one training minimum at least a month to bring awareness to the realtors and to each other and just share what's going on there. What can we do to really expand our business and support each other? So that's the main intention here. And I want, of course, participation. If you have questions, we'll answer them as best we can. If not, of course, we have resources to go back. But the main intention here is to offer alternative options and getting creative so that when we do go out there, and meet with our clients or connect with our clients or networking, we can say, hey, did you know about this program or that program that puts us outside of the box? So Champions Mortgage is a mortgage broker, and the benefit of this obviously is that we're able to offer many different mortgage options with different lenders versus if we're just a direct lender, we only underwrite to certain programs. So that is the benefit of Champions Mortgage. So today we decided, Sandra and I were kind of like masterminding, like, okay, what can we bring forward? What programs would be available with the changing market right now, with everything that's happening with real estate, you know, with the buyers and the new forms and everything, and really getting out there and connecting and, just allowing ourselves to be seen. So we talked with some of our lender partners, and two programs that we decided for today's topic is Home Ready and Home Possible. And the reason why we picked these programs was because these are programs that we could offer to low income and moderate income buyers, those that might need a little assistance. So we're going to talk about that today. And we gave you a sample flyer of what it would look like. If you were to be at an open house, you could co-brand, you could put your contact out there and just offer these programs and just say, hey, did you know that we had this Home Ready program or Home Possible program that you could come in with as little as 3%. So there's a lot of free marketing tools and flyers that we could support our realtors or our partners or our buyers. It's just something that we can pass out. Well, sorry. No, that's okay. Welcome. We love it. Thank you for bringing our living too. Yeah. So the Home Ready program offers financing up to 90% with your buyer coming in with 3%. Versus this is an alternate to, the FHA. The FHA, they require 3.5, so this one, they require 3%. And so we thought, hey, it makes a difference, the 0.005 will make the difference, an extra $3,000 that your buyer would have to come if they went FHA. So we're gonna go over some of the benefits of this program and how we can support those buyers that need some assistance. So the Home Ready program is a conventional loan. It's not an FHA loan. And once again, this is for borrowers looking to purchase with a low down payment or refinance with limited equity. So we'll talk about that, and it's ideal, like I said, for borrowers who need flexibility and income sources. So we could do purchases up to 90%, and these are for first-time home buyers. So the way we'll know if your buyer will qualify is there is a lookup tool. So with this lookup tool, we can simply plug in the address, and it'll automatically tell us if your buyer does qualify for the Home Ready or the Home Possible program. And then we can offer this. So once we input all the information, it'll tell us on our desktop underwriter whether it's approved or not for this program. So it's a simple lookup tool. We could just go in there and say, you know what, I think your buyer might qualify for this. So instead of coming in with the 3.5, your buyer can come in with 3%. We're gonna save them, depending on the loan amount, but the average is $3,000 to $5,000. Okay with this. The other wonderful thing about this, it does have reduced mortgage insurance. So any loan that we have to finance above the 80% does need what we call mortgage insurance. You can't get rid of this. You have to put this in your loan. What that does to our payment, of course, it's going to increase our payment because we do need mortgage insurance. With this program, they do calculate it with a lower ratio, which can bring your payment lower. So that's the other benefit of that. And then once again, when I said when we do the lookup tool, the whole purpose of this program is to have help people that haven't been able to buy into homes, the generational wealth programs to help assist certain areas, especially like San Bernardino County, Riverside County, areas where they're trying to, support homeownership. They want people to buy houses. And so once again, if they are within the 80% of the average median income, which we'll know once we put in that address, it'll tell us, and usually the average income for that would be like $78,000. Okay, so they're in that average medium income. And you guys don't have to know that because we can do that as loan officers. The loan officer that you pick can just go into the lookup tool and see if they're in that area and allow your buyer to qualify for this. So it's very simple. Like for those of us that are doing the loan, we just look it up and we know that they are in that area. Gift funds are eligible for the entire down payment. So they can come in with, the letter and say mom and dad or sister, brother, someone can gift them the funds for the entire down payment. So the 3% can be, gift funds for that. It's available for single and multi-wide manufactured homes. And the LTVs have to be a minimum of 95 to 97%. Once again, condos and planned urban developments are also allowed. And the great thing about it is your FICO score can be 620 or above. So typically most lenders will want a little bit more like 640, 680. So for a conventional at 620, this is a great opportunity. The other great thing about it is they will allow us to use non-occupant income, meaning if mom and dad want to go on the loan and help that child, get their son or daughter, whatever, qualify, we could use their income. They don't have to occupy that property, which is another plus because we get that, like, with FHA, it's like, oh, mom and dad want to go on there, but they're not going to live in the property. This is another tool that we could use. You know what? I have a program for you guys where we could do that. So once again, this is for open houses or as we're talking or as we're looking at the buyers or we're connecting with the borrower, we can say, you know what, there's another program out there that I believe you'll qualify, might be a better fit for you. So I'm not saying the other programs are not great, but this is another program that we could offer, another option that is an alternative to the FHA. Because most of us go straight to the FHA, but you know what? If we look at these benefits, now we have something to compare. I have this program or I have this program. And once again, we'll know if they're approved through that lookup. And once we run it through, which is our desktop underwriter, it's a module that we do as loan officers. And then of course, they do have to take a home buyer counseling class that is online, the person that's gonna buy the house, that they understand this program. So this is called the Home Ready program, and it is sponsored and underwritten through Fannie Mae. So Fannie Mae is the one that's supporting this. So then there's another one, and this is the one that we really love. So we talked to our partner, and we're like, okay, give us more. We want another program. Is there anything out there that someone can get a grant? Because once again, they need money. The whole thing right now is being able to save up for that down payment. And it becomes a challenge to some because right now the cost of living is high. Like we talked about that the cost of living and expenses are high. People are living paycheck to paycheck. It's hard to save up the 3% closing cost, or they have a little bit of down. Like the first question we do when people are qualifying for loans, like, okay, how much money have you saved up? Because we're gonna need money, and where is that money gonna come from? And this is gonna be part of us negotiating that offer that we're gonna submit. Part of what can we get when we're submitting that offer to help this buyer close this transaction. So the cool thing about this here is borrowers can qualify for a $5,000 grant just for being in an area that is considered low income and moderate income. And once again, we can plug in that address, and it's not where they're gonna buy, it's where they're living. So if they're renting or they're living in this area that they're classifying as a low income moderate, and they qualify for the Home Ready, they may be able to get $5,000 grant for that loan. And a lot of people don't know about this. And once again, it's available, but we go straight to our regular convention or our regular FHA. And once again, they can give up to $500 towards a 1-year home warranty and $500 toward appraisal costs. And so once again, we can talk about this. Obviously, if they don't qualify for this, or there's certain things there that they don't quite meet, then we have the FHA or whatever. But once again, this is an opportunity to get our phones ringing, to be able to offer programs out there that are competitive, that maybe other lenders are not offering or are not aware of. But once again, this is available, and it does have to be the primary residence located in that census tract. Yes.
How does the interest rate compare FHA to one of these
I'm
programs?
glad you asked, and that's why we got the answer. I told Sandra, make sure you know the rate. And so we looked it up. Yes. So we went to the absolute low FICO score of 620. And today's rates, and once again, I have to, put that disclosure, subject to FICO and all that wonderful stuff. We pulled it up at 6 and an 8 thumb, 6.125. Very competitive, very competitive. And then, so the range, if you want to give a range, because we don't want to quote interest rates unless we know, right? So you could range it, from 6 and an 8 to 6.75. On a 15-year, you could even get it a little bit lower. You could get it below 6, like below 6. Wow, that's at par. Because, we could get it down, buying down the rate, but we're talking par here, 6 and an 8 today.
Cool.
When it comes down to debt to income ratios, are they standard conventional debt to income ratios, or are they totally different?
No, they're, so the DU, when you run it through the desktop, the standard is, they said 50%, 45 to 50. So we still have the standard, but when you run the DU, it's gonna tell you if it's approved, eligible for that program. So yeah, it's standard. So it's kind of like they're matching it. Just see it as an FHA.
Yeah, because I know that
It's like
how
a
half
sister.
of the DTIs are a little bit different. So with the Home Ready, is it gonna be standard?
It's gonna be
DTIs?
standard, and once again, if it gives you an approved eligible at 55,
Then we're good.
we're good.
Okay.
Because once again, it's backed by Fannie Mae.
Got it.
So our partner is underwriting to Fannie Mae, and Fannie Mae rolled out this program, and so it's available. So they're just like, hey, this is available, and it's one of our preferred partners that makes our underwriting very easy. And this is the one that we said, okay, give me something. I need something here to bring to the table to get that phone ringing. So this is to get that phone ringing. Did you have a question?
Yes. The 5,000 grant where you said that it depends where they live.
Mm-hmm. The census tract.
So where they're renting, so it doesn't matter if they move somewhere away from the county or like,
Well, once again, every county has certain low to moderate income census tract.
but say they're renting
Uh-huh.
in, I don't know, let's just say LA County
Right.
right now.
Mhm. Yes,
And they're in that
right.
tract, but then they buy in San Bernardino
Yes,
County.
it doesn't matter. If they're in that low income, most of it, when we start playing with the look of the pool, you know, we're like, oh, let's put in my address, let's put that address, see, so what it does, right? The majority is gonna be in low to moderate income, because the whole thing is generational wealth. We're trying to encourage those buyers that haven't been able to get into a home. That's what this program's designed for. And also people that are not able to save up and their FICO score's not quite great. So, you know, the most success you'll probably have with this grant is gonna be San Bernardino, Riverside County, those areas. If you have an address and you're not quite sure, even your FHA, you know, buyers or some apps that you might have, applications that you might have right now, we could, you know, you could go in there, we could show you, because, you know, it will show you how to do it. And it'll tell you, and the beautiful thing is it'll pop up and it'll tell you home ready, home possible. And then it'll tell you what the average moderate income is. Like, you're gonna know what it needs to be. What we found out, it was 78,000. 78,000 was the income. And once again, if you need to qualify, you can have mom and dad come on, and they don't have to live in the house. So it's made special for that, yes.
I know it's a grant, but they don't have to pay it back?
This one's a grant, you get the money, you're good.
You're
You
not-
can use it towards closing costs, you could use it towards your down.
Okay.
Because we did ask our partner and they're like, use it however you want. Yeah, and then they might even get the extra 500 and, you know, for the 1-year warranty and the appraisal costs, you know? And once again, this is, you know, once we take the application, we do our homework, we run it through, we're like, you know what? You know, we said, I can call a friend, but I have great news. You also get $5,000. They're gonna love you, you know, because we're gonna check, and then once we know that, yes, they do qualify, then we're going to, you know, let them know. We don't wanna tell them ahead, make promises we can't keep, yes.
So if you do add mom or dad to it,
Mhm.
now all of their income has to be under the 78,000 combined, correct?
Yes, 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 yes. Because once
And it's not
again,
like FHA where both have to be on there, so if you only want to use mom to help, does dad have to be on it too, or could you
no,
only use
it's
mom?
non-occupant or, yeah, so say you have, you know, your son or daughter and they're making 40, 50,000, they're not quite there, mom makes 30 or whatever.
You can add her, but not dad.
Right, yeah. And once again, we could ask, because I know they do some exceptions if it makes sense. So we all know the 4 C's, common sense, credit, capacity, and collateral. Those are always what I always said, remember the 4
That
C's
first one.
in
that
everything.
That first one is hard.
First one is not common.
Common sense.
Common sense, well, underwrite, like, you know, if you're looking at the loan, then everyone's gonna be like, does this loan make sense? If it makes sense, they're gonna do it, because once again, they have to be able to take that loan and sell it to Fannie Mae. But I know it's like, no, that doesn't make sense. And we know, right? They have to have the ability to pay it back, because if they can't pay it back, you can get them qualified. But once again, we walk away and they have this payment and they can't make it, we're putting them in a bad situation. So once again, that's where the common sense is. And I tell them directly, like, I can get you qualified, but are you gonna be able to make this payment? Can you make this payment and have money left over for hamburgers and french fries? And they're like, okay, then we shouldn't put you in that. So that's what I mean, we're having a realistic, yeah, you know? So that's the home ready. Once again, yes.
Just a quick question, are these programs, have an expiration date or this?
Well, as long as Fannie Mae and then the ones that are the top, Freddie Mac offer it, our partners are able to offer it. Because remember, we're a mortgage broker, so we work with different lenders, right? Right now, this preferred lender that we underwrite and we close a lot of loans said we could do this. So as long as it's not like tell Halfa where once the funds run out, it's gone.
Yeah.
You know, as long as Fannie Mae says we're gonna buy those, then they're gonna continue offering it. But they have so many. There's a lot of programs actually. We're like, whoa, look at all these programs. But once again, they haven't been offered. So our goal here at Chances Mortgage is to bring those products, get everybody informed so we can start getting that phone ringing. And even if they don't qualify for that, there's many others they can, but we just have to, put our thinking caps on. But other than that, that's my part. I'm gonna turn it over to our beautiful Sandra here to go over.
Okay, so I'm gonna be talking about a second purchase program for first-time home buyers as well. This one is similar to what Lala had mentioned, but it does have a little bit differences. It is offered by Freddie Mac, and it is the Home Possible program. And again, it's an alternative to an FHA loan. They do offer 30-year fixed loans or adjustable loans, adjustable arms. They can do it for purchase and for refinances, and up to 97%. If they're looking to lower the rate, that's another possibility as well. They only do it for one unit as the primary residence. That's the only difference from, the Home Possible, where the other one can do puts or condos. With the FICO score, again, they're very flexible with it. We can go down to a 620 as long as we have an approved eligible. They're good to go with it. And with this one right here, the same thing. We do that. We can qualify the borrower with non-occupant co-borrowers on it. One thing that it's a little bit different than from the Home Ready program is if they don't all have to be first-time home buyers, and if one of the persons has already owned a home, nobody has to take that home counseling class. But if all of the borrowers or first-time home buyers, then they will have to take the home counseling class. So that's a little bit different from it. And the same thing, with our preferred lenders. They do offer a lower mortgage insurance, which can help and can make a difference at the end of the day when we're trying to qualify the borrowers. That's pretty much it for this one.
Question.
Yes,
If that's only on single SFRs?
yes.
No.
Now, the one before that, can you do units or anything?
Yeah, 1 to 4. I mean,
Okay,
except for,
okay.
1 to 4, yeah.
And the last one, you could also do it on manufactured homes?
Yes,
But
single,
on- But
they
on,
have,
on land, like on their own? land?
well, okay, those are, yes, so manufactured homes classified as permanently affixed.
Okay, yeah.
Right, so if it's permanently affixed, there is exceptions to single white and double white, because we have to make sure there's certain, guidelines for that. We have to underwrite like the year.
Yeah.
So yes, but there are some restrictions on mobile homes.
Okay.
And do
Or
they
not
have to,
mobile homes, I'm sorry, manufactured homes, yes.
do they have to two and buy downs on this?
Yes, you
Yes.
can, we did ask that.
With both of the programs, you can do the buy down
Yeah.
programs, whatever is best for the borrower. Okay, the next program that I wanted to talk about, which is it's a Home Possible program. And this one right here, it's a little bit different. Not a lot of other brokers might have it or offer it. And this is something that is with our preferred lender. This is something that they offer exclusively to the brokers that they work with. And it's a 0% for a purchase. It's through Freddie Mac, but this is something that the lender specifically offers. They will give the buyers either 3% or up to $15,000 towards their down payment. So if they're doing a loan and they're coming in with a 3% down payment, they can get a second on it, and that will cover the down payment. This loan is going to be a silent second. They don't have to make any monthly payments, and of course they can pay it down whenever they want to, or pay it off whenever they want to. It does have to be paid back when they either refinance or sell the home. Yes, I mean, this is another great tool, yes.
Is this Cal Halfway?
No.
It's not Calhapa.
No,
So-
it's directly
But
with
it
the.
sounds like it.
It sounds like it, but it's not Calhapa, and with this one, I feel like it has a lot more flexibility.
DTI flexibility?
DTI and the credit score as well, because you only need a
And
620.
the MI, yeah.
Okay.
And as long as, we get an approved eligible, you're good to go with it. And as far as the back end DTI, we can go up to 50%.
I have a quick question.
Yes.
So when you're gonna run a DU or LP on something like, do you run it the same or do you input something to show that we're going that way? Because I've ran before and I usually don't get an acceptable or an approve eligible. Anything under like 660, it won't give me an approval. So would it spit this out and say home ready only or home?
Yeah, it has to be a conventional loan.
Yeah.
So if you're
Oh, I
doing an
know.
FHA, it's not, but if it's a conventional, yes. He actually showed us a DU where it said, you are eligible for a home ready, home possible, but that person didn't even know. You know, or they put them through a
So
regular
my
conventional.
question was, do you run it the same way, or do you
Yes.
have to input something in there to let them know that we're
Yeah.
looking for this program?
That's a good question.
You could put it as a second because it is considered a second
Okay.
audit, so that's pretty
So,
much
so then
it.
I'm actually
Yeah.
applying for 100% financing,
Yes.
right?
Yeah.
Okay, so that's how I submit it on, this would be LP,
This
right?
is for LP,
Yes.
yes, so
Uh-huh.
at the time
Yes.
that we run the AMS findings, you would have to run it through LP,
Okay.
not,
Okay.
Fannie Mae or DU.
So that will spit out home possible,
Yes.
right?
Yes.
Or home ready, yeah.
Yeah.
It'll do it in parentheses, like this loan is
Well,
eligible.
but yeah, but the
for-
home rate is,
Yeah, something else,
yeah,
yes.
it's Fannie Mae.
Yeah,
Okay,
yeah, but for this one, you would have to go through LP to
Okay.
get the findings.
so even if the FICO scores are at 620, I don't need to input anything different, it will just spit out,
It would just spit
and it
out,
will say
yeah.
that.
As
Okay,
long as it's LP.
Yeah,
Yeah.
I mean, we could run it through our system through lending pad and we shouldn't have any problems, but then obviously when we submit it, we have to make sure that, you know, we do the 0% down purchase.
Got
But it's pretty much
That's
the same, you know, as far as the guidelines.
is there a rate, an interest on that 15,000? Do you know?
No, there's
No,
no.
zero. Oh, that's
No,
awesome.
It's deferred, so they don't have to make market payments on it. And this is not something that this is something that our partner is offering rather than, you know, Freddie Mac. So, and it's available until they tell them they can't do it anymore. So there's no
Yeah.
expiration or there's a time
Oh,
limit
that's
when it
good.
can be offered. Yeah, so I mean, that's always good, you know, with a lot of people, like, you know, they said if they need help with the down payment, this is a great program that can help them with it. Again, this program does have, you know, income limits on it. So, it's about 78,000 as well, so that's
Yeah,
about it.
in that area, yeah. Uh-huh. I wanted to say one more thing about this, aside from the ratio being lower in the MI. The other benefit of these programs is with FHA, you can, once the borrower drops the mortgage 80% or below, you can't take it off FHA, it's for life. This one, once, if your borrower in the future does drop their LTV 80% or low, the MI goes away. And so that's another benefit that we could do. And then also for those looking to do a rate and term only, they can go up to 97%. You know, so once again, if we're saving them, if it's a benefit to the borrower to refinance, to do a rate and term means 1% or less of cash out, then it might be something we could do for those streamlined, like people wanting to get out of the FHA and going to this, because FHA, you have to keep that MI for life until you refinance it. If it makes sense, you might be able to put them into, not the zero, but you know, the home possible or the home ready one, to get rid of that MI. You know, and that's another thing, like, hey, you're gonna build up your equity, you're at 80%, prices are going up, you might be at that place. It might make sense and the rates are dropping, so this is another opportunity.
Yeah, no, definitely. Another thing, with the home possible program, you do have a little bit more wiggle room with your DTI on the back. So if you get an approved eligible, you can go up to 59.49. I'm sorry, 50.49. It's a little bit of a wiggle room, and a lot of the times it does help because it makes a
Oh, it
big
does.
difference, you know.
Because I think Alhapa does 45 back end.
Yeah.
I think that's usually,
Yes.
unless they have 700 FICO scores.
Yeah.
So this is a huge game
Yeah.
changer.
As
Yeah.
long as you get, you know, get an approved eligible, you're good to go with it, so.
Wow.
Yeah.
You know,
I like the 59
As long as
back
everything was
end.
tempted to be back
I'm like, that's a reaction, everybody, want to make sure you guys are safe. Yes,
Still an income-driven, program.
yes.
Yeah.
Yeah.
Yeah, they go off of the average median income, which is around, for San Bernardino County, I think for most areas, it's around 78,000.
I think that's gonna be the biggest challenge for this one is having to meet that income and not to exceed that, but at the same time qualify for the house they wanna buy.
Yeah.
That's where you have to be very mindful of that, because what's happened to me in the past is they qualify for this, they're very excited, and they say, we have to stay there, and then they get excited, they go start looking, and then, oh, can I go 50,000 more, can I go, and then they start buying
Yes,
higher,
Yeah,
which is fine, but then you no longer qualify for this.
Right,
You have to
and-
remind them of that.
Yeah.
So,
Right, and
so the loan officer and the agent have to be very hand in hand
Yeah.
and making sure that we stick to this program.
Right, and the other thing with the census tract, but once again, you have that lookup map, you can look at the areas, like say, okay, well, where are you looking to buy? Oh, I'm looking to buy over here, okay, well, what area, so now you have that census tract area, you could look at, instead of looking at the address, you could look at the area. You could also use that to target that area, so once again, when we get informed about where are you planning to buy, we're asking those questions, we're gonna be able to look at that census tract area and know like, oh yeah, they're still in that income limit. That's how I would, people ask me, if we're worried about that or we figure that's a challenge, this is how I would counteract that. Yes,
That census tract, then are we gonna be able to have the access for that
yeah,
website?
everybody has
Yeah.
access to
Okay,
that.
then the second, well, it's not a question.
Well, I
but
mean, the loan officers, obviously,
Right.
because the realtors shouldn't have to worry about stuff like that.
That this program sounds like the Bank of America program that they had.
Yeah.
But that one was very
Yeah.
strict.
I know,
So this
Yeah.
seems more flexible,
Yeah.
so that's gonna work really well.
yeah. I know, I was in that call for B of A and I was like, ooh, that was
Yeah.
really strict, yeah.
Really strict
Yeah.
guidelines, I didn't like it.
I agree. Yeah,
Oh, no,
Is
go
that
ahead.
that's it, or,
Lala, I
yes.
think this depends on where they live now, right?
Once
Where-
again, well, it depends which one, it's where you're gonna buy. So once again, this is for low to moderate income buyers. We're trying to encourage generational wealth for maybe the newer generation that is unable to buy because of their income. They don't have the closing costs, the down payment. So that's the niche for this one. All those buyers that have been pushed out because of their income or they haven't saved enough money for the down payment.
Yeah, because you mentioned census tract
Mhm.
to locate the
Areas.
address, right?
Uh-huh.
But I think the address is their primary residence, right?
Yes, so,
As long as they live here, they are qualified for this, right?
well, for the 5,000, you get the 5,000 if you don't have to buy the house there. It's just wherever you're living.
Yes.
That's the home ready first.
Home house.
But if you're a buyer and you want to buy a house, say I live here, in Chino and I want to go to Riverside County, wherever Riverside County is, we could look at the income in that census tract to qualify, make sure that is that low income to moderate income. The income that we're looking at, the income, the 78,000. Yeah, we're looking for that. So the guidelines are 80% of the average medium income. And then the FICO, because once again, this niche is for people that haven't been able to buy, So if you have a buyer that has great closing costs, but obviously we're not gonna put them in this, So we have to know our buyer.
I think I know her question, and
Yeah.
it's kind of hard. I'm having a hard time.
Uh-huh.
Yeah.
Like, give me a perfect example. Say I live in Pomona.
Yes,
And you put that in. Say I'm renting in Pomona, and I want to buy in San Bernardino, right? Because that's what we're trying to.
right.
Like, how do we figure out if I qualify? Is it the Pomona address or is it the San Bernardino
Yeah,
address?
Well,
that's my question.
Yeah, I think we're getting it confused because for the 5,000, it's where you're living, not where
Okay.
you're buying.
So the Pomona address.
That's the
Okay.
automatic. You live here in the
Okay.
low income area, you get your 5,000. I'm gonna go buy in Riverside County, okay? What's gonna determine if you qualify for this is gonna be the
That
average medium income.
Okay, so two programs.
Yeah.
Yes, two different
Two
programs.
different,
So home ready
residents.
and home ready
Okay.
first.
Yeah,
Yes.
so
Okay,
one
good.
is Fannie Mae, one is Freddie Mac.
Yeah,
Yeah.
so the first one depends on where you want to buy. The second one depends on where you live, then you
Yeah.
can get five.
The 5,000 is just kind of like an extra, it's not like a
Okay.
bonus.
Right.
Oh, you just happen,
Okay.
you qualify for this. So I would, if they happen, great. If they don't, then we won't even mention it. Yeah.
Find an address, I'll be able to.
Yeah. Yeah, you can
Right.
Yeah. Anything,
What
so,
are the four
I
Cs?
guess,
any other
do you guys have
questions?
any other questions? Like,
Okay, yeah, and we'll share with you guys if you guys want more information. But I just wanted to thank everyone once again for supporting us. And then this is our Champions Mortgage team. Some of us might not know our whole team, but we do have a big team. So you can reach out to one of our loan officers. Yeah, we're just right there. She's amazing. But reach out to your loan officer, and if your loan officers, this is a great program to start offering. you know, just getting creative, and that's it. So we thank you.
Good job.